the rule of thumb was, $250 a door. I'm seeing stuff upwards of 2,000 a door, right? Depending on if it's in Florida, Texas, but it varies. But that's out the door. You're paying based on square footage, and it's not just rentable square footage; it's gross square footage. So if you have a 4,000 square foot clubhouse and pools and ancillary buildings and all these things that are not rentable, you still have to pay for it. So, looking at square footage, and then you have to look at what is the cost to repair? What is the cost to rebuild? And we know that labor material has gone up, and, what may have cost $80, $85, maybe $100 a square foot to replace is now $150, $175, $200. I've seen stuff for $350. And there's engineering software that's out there. And even when you get your appraisal done, it kind of gives you an idea on what the cost is to rebuild.
Welcome to the Lion's Den, the real estate podcast for perspicacious investors who know they have the strength to succeed in the lucrative commercial multifamily industry. Gain expert advice on your way to becoming a top performer. I'm your host, Adam Parrish. I have my three co-hosts, Niall Callahan, Lisa Parrish, and Thea Mosley. How are you three doing today?
Great to be here.
Thanks.
The obstacle of today's episode is what risks and strategies should I be aware of with multifamily insurance? And with us to discuss this crucial topic today, we bring on a special guest. He is a highly accomplished insurance advisor and risk management consultant with over 25 years of experience in delivering impactful solutions to his clients, working for several of the largest global insurance brokerages, including Marsh McLennan, NFP, and Hub International, before starting Avellino Management Group, an insurance consulting and outsourcing risk management firm that specializes in providing advice, functional risk management, and claim management services. Essentially, he's the dedicated risk manager on behalf of the investor, sponsor, and general partner group. With his vast experience and expertise in insurance and risk management in the context of multifamily properties, we are pleased to welcome Nico Iannelli. Thank you for joining us on the podcast, Nico.
Thank you for having me. It's been a pleasure.
And for the word of the day, what is the word of the day, Nico?
Oh, the word of the day is impact. Matter of fact, I even have it on my bracelet. So impact, it's the connection between our lives and the lives that we can change. So that's when I wake up to every morning. I got this at a speaking engagement probably about 7 years ago, and I wear it every single day. That's my drive. That's my word of the day every day.
Awesome. I love that. Yeah. I think that's actually a goal of all of ours as well, as we want this podcast to make an impact on all the people who want to get into this business and anyone we can help.
It feels so good, just being able to give it back and share, right? We want people to not go through some of the mistakes and challenges that we went through. So we want to be able to share and give them. And, I know, Lisa, you're with me and Adam, that, we feel better seeing other people succeed and grow. And that's what we're here for.
Definitely.
Sure. And for the first question I want to ask today for Nico, what does the process of working with an insurance broker typically look like on a multifamily deal?
There's your typical broker, and then there's dealing with me. Lisa has been spoiled. So I've been fortunate enough to work with Lisa for 15 years, right? And, going through starting out in the business and growing and then doing the larger firms. And typically, when it comes to commercial real estate, you want to find your risk advisor, your insurance advisor that you have a good relationship with. That broker is essentially should be going out to the markets for you, to the different carriers to see who has capacity, negotiate the rates for you, and then present it. I mean, ultimately, you're going to be able to come down and choose it. But so often, everybody, we see on commercials, 15 minutes or more, 3 minutes or more, we're able to save 10, 15%. Listen, commercial insurance is not your auto and home. It's a totally different game, right? So you need somebody who really understands your business model to be able to present it. A lot of times, a lot of these properties I know from past, that we are looking at, they're in emerging markets. They are, mismanaged, and, it needs a lot of loving care. So, we want to be able to look at the past, the history on the property, but we also want to share with the underwriters as far as what our business plan is and present that to help offset some of the risk and hopefully, reduce some of the costs. But, you really want to work with somebody that is going to understand your business and go out for you. I mean, over the years, the last 20 years, I see different things. There's folks down in Texas that they're telling their clients, reduce your deductible because we're going into hail season so we can get a new roof. Folks, this is why rates are going up 5 times in Texas, because there's not enough capacity. These companies are folding left and right because there's not enough money. So, you need to be able, somebody to really understand what your business model is, as well as to make sure that, what the total cost of insurance is. It's not just what your premiums are, but you need to know what your deductibles are, what risk mitigation that you need to do. Are we looking at this property that we need to do remediation for aluminum wiring? Are the roofs old that need to get done? Are there trees? These are all things that we have to take into account for total risk. So, when you look for somebody, it's not all about price. Listen, price we know is a big concern for all our clients, but it's what the total cost is going to be, either at the beginning or at the end. And, Lisa, we can share a story later on why it's important, because, you got to pay one way or another, but you need somebody that you can grow with, that you can trust. And that's why I kind of made the move. And I'm just working on behalf of my clients, and I get to negotiate with the brokers and making sure we have the right coverages in place. But you want to find somebody that, you can work alongside, and, they're working on your behalf and going out there and explain everything to you.
That is great practical info. It's good.
It's going to be somebody that you really trust too. And, so we started working together. Nico, he came to my first property, that first 23 unit complex that I was talking about in Monroe, North Carolina. And he met me out there. I think we had like State Farm or something like that before. But he met me out there and started educating me on insurance. And I was like, oh, wow, I had no idea. No idea. Because all I knew was, the Geico commercial or whatever, those are the things that you see, but you don't realize the big difference between, like you're talking about, other kinds of insurance and then commercial multifamily, especially when you get into bigger units. But yeah, he came out there and met me, and then I haven't had to think about, I've been spoiled. Spoiled is the right word. For 15 years, I haven't had to think about insurance. So I really don't actually know all that much about insurance, because I would just go, I don't know, let me call Nico. So everything that I know.
Even if there's a fire right before Christmas too.
That's the story.
Oh, God.
When we're ready, we're going to tell that story.
I've heard a lot of fire stories recently.
Hey, it's Christmas Eve, the day before Christmas Eve, and you go Christmas shopping for your kids. What are you doing? You're going through a burning building.
Hold on, should I tell the story yet, or Adam's going to ask us?
Yeah, go right into the story.
No, I thought that story. Okay. All right. So, these are some ex-partners of ours, not Ryan and Tyler, that it was really kind of their decision on what to do with insurance, and insurance rates have been going up year after year. Actually, every time we go to do a deal, insurance rates are going up.
And this was several years ago too.
This was 2017 or 18, something like that. And so we're buying a property, and the rates came in higher than we expected. And so we were kind of in trouble on, trying to figure out, because we were going to lose loan proceeds. If your rates come in too high, you can lose loan proceeds. And so my partners kind of freaked out, and we had a conversation. Really, they had this conversation with Nico. I was listening to it, and they wanted to reduce, tell me if I get this wrong, Nico, but they wanted to go with the lowest amount that the lenders a lot of times will allow you to insure for a lesser amount per square foot, but it's not actually realistic for replacement cost. So they wanted to go with what the lender had allowed. And Nico said, I don't remember how off it was, but it was quite a bit.
Oh, I remember.
Okay. Then you can fill in all the details. But the point I wanted to tell, and then Nico will fill in the details, is they listened a little bit. They did raise the amount, but they did not listen to you. And we closed on that deal. And 3 days after closing, a whole building burned down, 16 units. And it was a few days before Christmas. So just to add on top of everything, because it's hard to get anybody to do anything right around Christmas. This was in Columbia, South Carolina, and Nico lives in North Carolina. And as soon as it happened, I got on the phone with Nico, and he was I don't know if you do this every year, but he was last minute Christmas shopping for his kids.
I do it every
And
year.
you did every year. Okay. So it was only a few days before, and he dropped everything and took a trip out to South Carolina and spent, I don't know how long you spent out there, but at least a full day out there evaluating everything, making sure that we had the, safety, because we didn't want to end up with additional problems and additional lawsuits on top of everything. We had to make sure that everything was safe, get the, a fence around the whole building to make sure that nobody could go into it and all these different things. But if you want to explain like kind of more what happened, but my real point of the story is that, so I knew that I trusted Nico, and I knew that Nico has been my advisor for years and years. They hadn't worked with you before and didn't have that trust and didn't believe that you had our best interest, I guess, or they were just being cheap. But you don't want to be cheap when it comes to insurance, because we ended up getting quotes on how to, on rebuilding that building, and the cheapest people that we could find, and we did a lot of quotes. And I mean, when you're doing the cheapest, that doesn't mean the best, right? Was $1.2 million short of what we were getting from the insurance company. And that was because we didn't insure the building enough. And I mean, it was probably $2 million short of what we really should have gotten. You want to elaborate on that story? Or?
Yeah. So here's the thing, right? So as far as when you purchase the insurance, there's a couple of different factors, right? So you have your property. Your property, you're going to pay based on square footage. The older properties are more at risk. We're also looking at the history. Have they had fires, things like that? The property, are there shootings? Is it a high crime area? These are all different factors that go into play, as well as, the geographic region that it's at. So we had a property that, had a very rough history on it. So, but it needed a lot of love and care, but it was a good opportunity. But, going through, the rates, looking again at the total cost, taking into account. So it came in higher. Now, the amount of insurance you get is based upon, and I know Lisa did a plug earlier in the week, 15 years ago, the rule of thumb was, $250 a door. I'm seeing stuff upwards of 2,000 a door, right? Depending on if it's in Florida, Texas, but it varies. But that's out the door. You're paying based on square footage, and it's not just rentable square footage; it's gross square footage. So if you have a 4,000 square foot clubhouse and pools and ancillary buildings and all these things that are not rentable, you still have to pay for it. So, looking at square footage, and then you have to look at what is the cost to repair? What is the cost to rebuild? And we know that labor material has gone up, and, what may have cost $80, $85, maybe $100 a square foot to replace is now $150, $175, $200. I've seen stuff for $350. And there's engineering software that's out there. And even when you get your appraisal done, it kind of gives you an idea on what the cost is to rebuild. So that kind of gives you an idea. And based upon that lets you know as far as how much insurance you need. Now, on the flip side, the lender also comes back. And this is where, especially in Texas and Florida right now, where people are losing properties and, because rates going up and interest rates, there's some pushback on the lenders. And we've done this many times over the years, is that the lender is going to kind of tell you, this is what you need. You need to insure for this value, and your deductible can only be this low. And we need this, we need that. And sometimes they want to overinsure the property, which, we don't want to overinsure. We want to make sure that we're at least brought whole, So right now, with a lot of markets, there's a lot of pushback for the lenders to kind of get up to speed. And it's not so much just to bring the rates down, because understandably, like Fannie and Freddie, okay? If it's an agency loan, small business, they're going to have a minimum deductible of $25,000 or $50,000. If it's a small property, if it's your first, all right, it might be higher than we might have on your home. But, when you start looking at larger portfolios, we're starting at $250,000, $1 million that we're self-insuring, right? So, you're kind of taking that part on. So the property, again, going back to replacement costs, we did the evaluation on the property. We looked at the appraisal. And at that time, it was about $95, to say, a square foot to replace the buildings, which would have gave us enough that, God forbid, if something happened, the building burnt down, we would have had enough money. Well, the two unnamed partners thought that they knew better, and they were new in the business. They had a lot of money, but they were new. They thought that they can rebuild it for $55 a square foot. And they were comparing it to a mobile home. And we had, I don't know, we had what, 300 units at this property or something. So we tried explaining, we showed everything. And even the lender was saying, hey, like, it needs to be a lot more, like, it's not doable. And when you go out to the insurance markets and to the carriers, like, they have an idea on, what the replacement cost is going to be, because a lot of these properties, and your lender's not going to want the depreciated or the actual cash value. They want to make sure that there's enough money if something happens that we can be identified and bring the property whole. So they kept going back and forth. And I think they decided from $55, we got them to go to 75 or 72. And I was like, it's not enough. And they're like, no, we'll self-insure for the difference. And I had to cover myself. So I made sure I had everything documented, that we presented it. That's not what I recommend. Like, because you're on the hook for, at that time, it would have been $350,000. And then, we run into delays and everything else. And then it's not just a 1.2 million that they're short, but it's not my fault, because it's not what I recommended. Because again, having the right partners, when they say, yeah, don't worry about it, like, we're okay, we're self-insuring. One, you need to make sure that capital is available, right? So, if there's not that much money in the bank and you're self-insuring for $1 million, like, you need to make sure that the money is there. So they decided to go for 70 something dollars a square foot. We get everything signed. Lisa's like, I don't know, but they said they have the money. I don't feel comfortable, but like, I have to go with the partners on it. Okay. It's your property. You're on the hook for 350,000, whatever it is. At a minimum, understand that also we had to convince the lender to go with it, which they signed off on it because the money was supposed to be available, right? If something were to happen. 3 days after we purchased the property, Lisa calls me in the middle of the night. There's a fire. Yes, it was a couple of days before Christmas. Like, yes, I do wait till the last minute. So, we've already been doing business for years, and the property was about an hour and a half, 2 hours away from me. So I just jumped in the car, went down there. Thankfully, all the residents were safe. They were able to get out of the building. And, and we learned that, you can't fix stupid. We can educate our residents as much as we can. We want them to feel like they're home, to take pride in the communities that they live in, but you can't fix stupid. If somebody's sleeping with a joint, like, and burns the couch, like, we can't stop that. It happens. So, but thankfully everybody was okay. But here I am, 3 days before Christmas, walking through, there's a burnt building, and the insurance company, they came out, they did the adjusters were out there right away, got all that. And when they went in and saw the damage and they did the assessment, like, they just cut the check for, I don't know, the 1.3 million, whatever it was, and says, that's it, we're done. We know it's going to cost you a lot more to rebuild. And we had all the specs from the engineers, but like, this is all we had. And the partners, again, knowing more than everybody else in the world, they said that they were going to go back and negotiate with the insurance company that they should get more. I'm sorry, but when you purchase it, right, everybody has to do their due diligence. And, you get the insurance, and the insurance carriers do go out to inspect the properties afterwards. Some of them do it before. One, we want to make sure we're insuring what we're insuring. The building is there. It's wood frame. How many units? If you say it has sprinklers and they go there, it doesn't, your rates are going to go up. But they've thought that they can go to the carrier and, we're going to get more money from them. Yeah. We went through it. This is what you purchased. This is what you signed off on, against all recommendations. Doing this for 20 years. And I'm sorry, you can have a couple $1 million in the bank, but like, if you don't know what you're doing, this is why you have to have
And
the right
how did they reward you? They fired you.
So they decided to go. Yeah. So they got another broker, that here's my new word that I learned from folks up north, hoodwink. So, they kind of told them what they wanted to hear, and they moved everything. And, again, having the right broker is almost like having the right partner, right? So if your broker's telling you like lower your deductible so you can go get a new roof on, a $20 million property, it's going to impact you. If they're telling you, well, you don't have to insure all the buildings, we should insure for 20 million, but you only need 5. I'm sorry, but how do you pick and choose which building's going to catch on fire or something happens, right? So it's one of those things. It's stuff learning that some relationships can go sideways and some of the things to look for. Again, it's like kind of like dating. Everything can be good up front at the beginning and until it might be too late, you might be married.
But you have we have to remember, like I was in a different situation in that particular deal. They, it was all their investors and it was different. But, typically when we're doing the deal and we're the general partners and we're out there raising money or, even if you're not the one raising money, but you are responsible as a general partner, you have to understand that we are responsible for protecting our investors' money and we have to do everything, within our power to be able to do that. And insurance is one of those ways that we protect our investors' money. Because if we don't listen to our, expert consultants and we don't take the advice and we don't insure for the right amount, and then we're out a bunch of money, guess who loses their money? Investors lose their money. We may have to do a capital call. They might have to put in more money. That's irresponsible on the general partner. And that's something that, I kind of knew that at the time that I was going through it. So you're right. You have to choose the right partners because if your partners don't care about that kind of thing, it put us in a bad fiduciary spot as well. So, everyone needs to be responsible, making sure that we're not overinsuring or underinsuring. It's so important.
Yeah. You don't want to overinsure, right? Especially now. Again, price is a concern for everybody. So you don't want to pay more, but you want to make sure you have the right stuff in place. Right now, we've been seeing year over year, we're on, I don't know, 28 quarters now that rates have been going up. They've been up probably about, in some markets, at least 20%. There's others like, again, Texas and Florida where it's 5 times. It's insane. It's just a matter of capacity and what's there. But you got to look at, a couple of things that have been going into play. One is every time we had a catastrophic loss, catastrophic are these hurricanes, these ice storms that are coming through, tornadoes. I know Donato had a tornado warning earlier. These losses, if we look at the last 5 years, 10 years, and even going back further, every time there's something catastrophic that happens, there are $1 billion plus losses. So all the insurance companies, like you're paying your premium dollars and they're all going in. Some of them have like a big pool. Now, if something happens, they can pull from. And keep in mind, the insurance companies get what's called reinsurance. So that way, when they have their say their stopgap, they have something to pull from. And, storms, again, $1 billion. When we look at the freeze that happened in Texas last year or the year before, I think the year before, I don't know how many billions it cost. These things all go into effect. The rates have been going up, the property rates, especially with older properties. Because it's not a matter of if it's going to happen. It's a matter of when. It can happen 3 days after you purchase a property. It can be right before, you held on to it for a couple of years. And, something's going to happen. And, we try to minimize as much of the risk we can, but stuff's going to happen.
That was my first loss. In all those years, that was my first. Well, it was my first one, so it's never going to be another first. It's not my last, I'm sure, but that was my first one. And so I went 10 something years without a loss. So that's, it can take a long time for it to happen, but you just always have to it's better to be safe than sorry. I guess it's like cliche, but it's true.
Yeah. And then we look at the history of this property, right? There was one property that, a building burnt down every year for the last 5 years. So it kind of gives you an idea like, hey, this might not be ideal property because you might not even be able to insure it. But the way that the rates have been going up too, there's again push for increasing the deductibles on what you want to self-insure. Again, if you have the capital, that's great. Okay. And you got to be able to get the lender sign off on it. But hey, you need to raise your deductibles 100, 250,000 on a larger portfolio. If you have the funds available, then you can do it. Nobody wants to pay it, but like, understandably, in some markets, we're looking too that there's different deductibles for wind or hail or a named storm. And it's, again, that's what it is. So like a hurricane is named. So you can have a different deductible on it. And those are all things just to keep in mind there.
Nico,
One thing you said that I wasn't surprised about, and this, the podcast is geared towards newer people in multifamily, is you said that they were new and that they had money. And I think that's one thing, as we talk to newer people that are getting into the business, that I really, really try to stress to people, whether they listen or not is a whole nother story. But people seem to think that if you succeeded in some other business, that you can minimize out the sponsor's cut and you can figure it out on your own because you figured out this business over here. And a lot of the deals that I've seen lost last year, there was a few deals lost. Whether even if you're a contractor, even if you are a plumber or a roofer and you get into this business, I feel like people shouldn't assume, like, you got to come in going, okay, I'm going to listen to the sponsor. I'm going to find someone like Lisa that knows what they're doing. They know how to transition an asset. They have professionals like Nico, rather than I'm going to come in, I'm a business person, I'm savvy, and I'm going to minimize out everybody, their cuts and everything like that because I know what I'm doing. And so many deals that we don't talk about are lost for that very reason. It's when you're going into something new, you have to have humility, no matter how smart you are, you got to learn from people that are already doing this particular business.
I totally agree because they were successful in whatever they were coming from. So they thought they knew it. And I don't even, I say all the time, I don't know, but I do know usually who to go to get the answers from. Or to not go. I was hoping he wasn't
technical challenges today.
Hey,
So.
he's having a lot of issues.
Zoom keeps doing updates. Yeah.
Is it Mercury in retrograde today or whatever? I don't know. Communication problems. Who knows? But yeah, I really appreciate mentioning that because that's something I hear all the time, especially if people have real estate experience. We have partners on our, like, Brett flipped houses. He didn't act like coming into this like, oh, I know what's up. I flipped houses. It's like, no, let's find some mentors here that can teach us how to actually do this aspect of real estate.
And the market's constantly changing too. I mean, keep in mind, how it was last year, 2 years, 5 years ago, it's not the same as it is today. It's a little bit different, right? And there's definitely some value that can be brought in from having other successful businesses and things like that. But the big thing is the members on the team. Like, everybody is an asset. They're able to provide something, right, on the whole thing. Like, Lisa comes to me, even if we're using a different broker on it, but just for having that perspective on, how we're able to minimize our risk on it and be able to push back and negotiate, whether it's with the lender or the broker that's there. And if somebody's savvy in business, they might have a better understanding, but they might not see, even in their own business today, outside of real estate, that how the markets are affecting it, that the costs are going up, whether if they have cyber insurance or liability, things like that. Those are all different things that are going up. So they might not be involved in that piece. And also understanding that, we're talking it's apples and oranges. Multifamily is a totally separate market, especially when we're looking at BC, we'll call them tender loving care properties we're in need of.
Right. I have a question for you from new people's points of view. Okay. So what is your opinion on people picking multiple states? Like, when you're just starting out and you don't know the business at all, not like, kind of a year in or having some experience and learning from other people. What is your opinion on new people just starting out picking multiple states to look for properties? Do you think that's a good idea?
For each their own. I think that whatever market that they picked, one, why are you picking it? What's the connection? Where are you going to be able to dive in? And we know sometimes if you spread yourself too broad, like, you can't it's too much. You can't do it. You know, everybody wants to go to North Carolina. Everybody wants to go to Texas. Everybody wants to go to Florida, you know, the hot spots. But the hot spots, by the time you get there, like you're past the curve. I mean, Lisa knows, I mean, we were into properties for a couple of years, which was emerging. And all of a sudden now you start seeing these big investors coming in. And that's when you know it's all right. It's, we got in at the right time, right? So we got in before, and I think that was up in Hickory, North Carolina. And that
Yeah.
was great. And then you start seeing the big institutional investors coming in
We were the first
years
ones into
later.
Hickory. We
Yeah.
were the first ones in, and then like a year later, everyone started coming in.
But you
We're
want to be able
certainly
to
not the
have
first
some,
in Arlington,
I know.
for sure.
but you want to be able to, you know, be able to either have somebody that's boots on the ground, somebody that you can trust that's there. You know, it's okay that if you have properties in multiple states, you know, if you have a good property manager or, you know, whoever your risk manager, somebody that is able to get eyes on to make sure that the property is being maintained, the tenants are compliant on everything, that, you know, they're taking care of it. Right. And because we have a fiduciary responsibility for our investors. And like Lisa was mentioned earlier, listen, insurance, everybody thinks about just like the building. All right, listen, we have a bucket of money. If the building burns down, you know, this is how much money we have for it. But all these properties, we're all looking at it for cash flow. That's how we're underwriting it. That's how the lender's looking at it. And if you lose 16, 24, 100 units because they're down because of a fire, you got a loss of revenue coming in. You still got your notes. You still have your expenses. What do? And business interruption is a big piece of the insurance, but nobody talks about it.
Well, you know, a lot
Right.
of people think, and sorry to interrupt you, but just to add to that really quick, a lot of new people think that, well, we'll just make sure that we get the, you know, that the insurance company is going to reimburse us for the loss of rents. But what I learned during that circumstance was we had just taken over this property and well, maybe I'm wrong, but this was what I learned, and, you know, tell me if I'm wrong. But when you're taking over a property, a lot of the properties that we take over, it's because of bad management. And so they might have an occupancy issue. So when we took this property over, it definitely had an occupancy issue. And that 16 unit building that burned down was not highly occupied. Didn't have 16 tenants in it. It had maybe 5 or 7. I don't know, but
Eight.
several, 8. Okay. So you remember really
it had
like,
eight.
I think I blocked it all out. But it was about 50% occupied. So the insurance company is not going to reimburse you for money that's has never come in. They're looking at the previous rent rolls. So we did get some money for rent, but it's not for the full amount because we didn't have the opportunity to be able to actually ever rent it out, lease it out.
Yeah. I mean, and there's a couple of things I'm working on now, you know, where, you know, we're looking at the occupancy, but, you know, on a property that client purchased, and again, track history of go in, acquire in the first 30, 60, 90 days. This is what we're doing. It's turnover units. So even though we might have a couple of units down, we're able to turn them around quickly and, you know, bring them up to market rent. And this is the loss of revenue that's coming in. But the whole thing for insurance is to indemnify you. And what does indemnify mean? It's just to bring you whole. It's to bring you back to the position before you had a loss. So if your occupancy on that building, say, is 50%, that, you know, the loss of revenue you had was 50%. So at least, you know, part of the insurance will cover that business interruption that you had. Now, also keep in mind that just say, you know, we were fully occupied, you know, we're 16 units, but we have 50 units that are still empty. You with those 16 units, we can place into another unit. So, you know, we can do it. So it's really not a loss of revenue. I mean, the residents displaced and put them into another, but those are all things to keep in mind, you know, especially when you're underwriting any cash flow. And, you know, the lenders, some of them are more sticklers than others, but you look at their requirements. A lot of times it's to safeguard them, but it's also to safeguard you and your investors to make sure you have the right insurance in place. And Lisa can tell you, there's many times I push back with the lenders because what they wanted was way more, wasn't reasonable. And, you know, we pushed down, and there's times where lenders they just want to cover their loan. So if you have a $30 million property, but you know, it's only for, let's say, 18 million, they're good with 18 million, but I'm sorry, but you still have no, it's $35 million that you have invested in there. Like you can't like not insure the rest of it.
Right.
Mm.
Yeah. And Fia, my opinion on what you had said earlier about, newbies going to a bunch of different markets. I think that, my opinion on that is it's pretty complicated when you're starting out and you're going into different markets because it takes a long time to learn that market and to have the relationships that you need, contractors and
Yep.
staff and all the different relationships that you need in each market. So that's why we did slowly. We were in North Carolina for a long time, then South Carolina, then Texas. But in an insurance standpoint, though, when you get bigger and you have a lot of units and and you're spreading your risks to different markets, I think that is a good thing, right, Nico? Because if there's a hurricane in one area, you're not wiping out your entire
Okay.
portfolio. So I think in the long run, when you have more units, it makes more sense, especially if you're big enough. And I don't remember how many units, but many thousands of units. I think Ryan and Tyler are doing this now, where you can actually have one like umbrella or blanket insurance over all your properties. And then it's going to look less risky if you're not all in one market.
Yeah. I mean, it's just diversifying your portfolio because I spoke to them for several years about it before. But, when you're looking at this, especially with the larger investor groups that we're dealing with, they have a diversified portfolio. They'll have, there is some B properties, maybe a couple C, there might be some A properties in there, but they're spread out, right? So if all your properties are all concentrated in a high risk area, like just say Texas, or you're in Florida on the coast, it's going to be a lot more than, hey, we have a portfolio in Arkansas, Tennessee, Arizona. I mean, there's folks that rent everywhere. There's multifamily everywhere. But so if you have a portfolio that has been performing well, they're newer or if they're updated. Hey, listen, you can have a building that was built in 1890, but it was totally gutted in rehab in the last 10 years and, elevators, sprinklers, all that stuff that's in there. They're looking for the updates, right? So, but, be able to diversify that, and then you can be able to share and show, and hopefully it weighs out. So, typically we know like Texas, the rates will be higher than, let's say, I don't want to say Arkansas because we have issues with tornadoes, but there's other areas where
Arizona,
Arizona, yeah.
there's fires, but I mean, it's pretty
It's not
much
like anything crazy.
nothing major really happens in Arizona. Maybe
California,
some
Oh, weird
weather.
monsoon stuff. Like when we came to visit, I was like, what the hell is this weather and landscaping? It's so weird.
But
It was
it's
like
very-
boiling hot and then pouring and lightning everywhere.
But I believe it's pretty low risk though, as far as damage. Like I don't remember ever having any kind of damage here, and I've lived here my whole life. So Arizona.
again, knock on wood.
Yeah, no, knock on wood.
So start in that one spot, and then as you're growing your portfolio, you should diversify just like anything else,
Should.
but really get to know an
And then-
area and taxes
Build-
and insurance
build
and everything
a
else.
portfolio in that particular area, and then once you're solid there, then move to the next market. That's how we did it. That's what I think makes sense.
Yeah, I mean, you're doing your due diligence. I mean, you're doing your research on all the areas, right, on the property and the areas around it, right, to see when you're doing the underwriting. And the same thing goes with the markets. And you want to be able to kind of gauge on where things are going to go. I mean, right now, like markets like Texas, it's going to be in turmoil for quite a bit because, especially in Houston, because it's a lot of older properties. There's been a lot of acquisitions last couple of years. And, we're dealing with issues like rates going up, especially on these bridge loans that, everything's getting adjusted and insurance rates. And, folks are walking away from properties because it doesn't make sense underwriting it. We got, a couple of years ago and I was ahead of the curve and say, hey, this is what I see happening in the next 6 months. And sure enough, like rates jumped up to there. And we were kind of getting prepared for it. You're like, no, we're going to go. But sure enough, when we got stuff back from the markets, we made the adjustments. And there's also some like carriers that are out there or programs that are available that everybody was going to because they had lower rates than everybody else. Well, what happened last May or the year before? They went belly up, right? They couldn't collect enough premiums to pay out for all the losses. So now we had thousands of properties, portfolios in Texas that everybody had to go find new insurance in 60 days. So what happens? Supply and demand. One, there ain't hard enough properties to insure. And there's only a handful or two of companies that would maybe even consider it. And that made rates go up. And what happened? We had more losses. So, and rates keep pushing. And the lenders are like, no, we're in Texas on the coast, but we only want a $25,000 deductible. I'm sorry, but it's not even available. Like, your wind coverage, you're probably looking at self-insurance for at least 100,000. So it's the lenders have to do their part, and kind of get practical, realistic with the market on what's available for it. And I think collectively, us as, with the property managers and looking at the risks on this whole thing on, what are we, what's the total cost of insurance? What are we willing to self-insure? What are we doing? Or
The
something
lenders need to
happens.
get an insurance advisor, because a lot of times it seems like they don't actually keep up with what's going on. They have this, this is our policy, but as the market's changing, they're not adjusting with what's going on with the market. So you had to educate them many
Interesting.
times.
Yeah. And there's things that we run into because sometimes, these lenders are, they're securitizing their mortgage portfolios, right? So part of their security agreements is they need to have certain requirements that are on there. And we had to push back with their consultants that are on it. But when, as far as when it comes to securities and stuff, like it has to kind of be a certain thing. So, it's going to be the investors the lenders going back to their board, and with the securitization of these, let's say these mortgage-backed securities on, it's got to get adjusted because it's not doable.
Good
Did someone,
information.
hold on. Did someone mention market research? Could have
Yes.
sworn I heard someone talk about market research.
Market research all the time.
Speaking of market research,
Wow, that was smooth, Adam.
an easy to use market research tool with all the necessary data in one place is like a well-organized toolbox for property buyers. It helps them quickly identify the key insights and trends that matter without being overwhelmed by too much information. With all the necessary information at their fingertips, property buyers can make informed decisions quickly and confidently, avoiding analysis paralysis and focusing on identifying the right property investment to meet their goals. Introducing Bright Investor, the ultimate market research tool. Bright Investor visualizes data trusted by thousands of investors who want to know what's happening in real estate markets. Proven data from trusted sources such as Adam Data, Rentometer, Rimometer, Mashvisor, U.S. Census Bureau, and more, all in one place so that you save time and money. Don't be a dim investor, left in the dark, struggling to navigate the tumultuous landscape of multifamily real estate without the proper apparatus of market due diligence. Become the bright, market-savvy investor you're destined to be today with Bright Investor, and use code A&E for 10% off at checkout.
Oh man,
Adam,
we have a competition.
Adam, what's that code again?
The code is
Uh-oh.
A&E,
For
10%
GLC.
off at checkout.
Or AMF. We're all in
We
competition.
all have our own code.
Those codes don't work. Don't listen to them.
But yeah, I angry faces on all of his posts. It's inside joke. But I feel very, very privileged. And Otto and some other partners started Bright Investor, and we've kind of looked through it, and it looks very easy to use. And I know the amount of time that he's put into researching cities and all the research he does around just an apartment complex. It's every single time. He puts so much time into it. So it's a great tool. And like I always say, a lot of multifamily tools are $2,000 a month. This is like $49 to $100 a month. Probably not forever, because I have a feeling, it's going to really, really be a big thing, really good, and a good price for sure.
I had another
I
question.
mean, it's giving me the market research that you need. Sorry, go ahead.
I was just going to ask Nico you another question. Like, what are the most common types of insurance you usually get on a multifamily property?
So, typically, the first thing is, let's say the first bucket is property, right? So your property insurance, which is to cover the building, or if you put the building upside down, everything that falls out that we own, the clubhouse, things that we own, the office, things like that. So that's your property coverage. And with that, there's coverage for, all risks, which covers all claims. We run into wind and hail, hurricane, which might have different deductibles on there, earthquake, And believe it or not,
Well,
it's not just limited to California. I mean, there's, South Carolina, there's Arkansas, there's a few other places where we ran into, things that it's required. Flood insurance. I think every property needs flood insurance, but some of them are definitely in a flood zone. Your lender's going to require it, but we see all too often on even 2 inches of rain on what damage can occur. And I know you mentioned about Arizona, right? Like the landscape is different with all the rocks, and the rocks allows for drainage. But again, if it's compacted underneath and it doesn't allow the water to actually go down, you're going to get water
we have
rising.
flooding. We definitely have flooding.
Yeah.
Yeah, because
Right.
of the
So there-
mountains too. That adds to it.
Yeah. And there's stuff to mitigate. I did it at the house. There are these like honeycomb things that go under, and they use them in the football stadiums, which, you fill up with gravel, you put sod or even more rock on top, but it allows the water to go down and drains. And, if you're running into issues in your parking lot, that are there, it's a great product. And I don't remember the name, and I don't have a discount code for it. But it was pretty cool because you can drive a tractor trailer on these things, but it's pretty amazing. So those are some of the things that are out there. But, other lines, I mean, flood insurance, again, I think everybody needs it. More properties are required. You have your general liability, your slip, fall, your bodily injury, if you get sued. You got your umbrella coverage, which goes above and beyond. If you have your own software company and you're holding resident information, we've seen things come up where it's cyber attacks. So your cyber insurance that's built in there. Also for your investors, or if you have a board of directors, you have your directors and officers, your professional liability, your reps and warrants. So these are all different things that go into play, but your typical is going to be your property, your general liability, and the umbrellas with the lender's got to require. And under that, what are we actually covering?
Mhm.
Good information.
Yeah. And then, there's some groups that, we're start seeing that the investors, they want to make sure, because when we're presenting the OM out there, right? So we're representing, and we understand it's a risk, but we're able to share based on, our past experiences, on performance, on what we're able to do, and understanding that, again, it's a risk, and on there, we've been knock on wood successful on getting great returns, but also, it's almost like with the realtors, the brokers that you're dealing with. Some investor groups are looking for, for those that are raising money to have, call in errors and omissions or malpractice insurance to cover them, just to make sure that what you're presenting to me to invest in is actually there. And that's a safeguard. And we've been seeing that the last couple of years. Folks have been looking for that more and more. It's not cheap, but it's, again, as you're doing more and more stuff, you look for. And talking about like newbies, I kind of joke around when somebody calls and like they reach out and they want to quote. I haven't quoted anything in like 15 years. Right. So like they're so hung up on, again, watching the Geico commercials. Like, listen, you're buying a like multi-million-dollar property, right? There's a lot of things that go into play. You're not sure when it was built, when it was updated. If there's aluminum wiring, and believe it or not, in this day and age, there's still properties that have aluminum wiring, even though it was supposed to be replaced back in the 70s. But there's things that come up, right? And we can do our best to kind of estimate based on the market and what we're seeing, to kind of get an idea on the rates. But like, listen, it's not, I'm going to make a phone call and get a quote in 15 minutes. It's not happening. And the underwriters won't look at the property until you actually are in contract, the contract signed, you actually did your due diligence, and we're able to get the info that is needed so they can actually underwrite the property and get us a firm quote.
Some solid information.
Yeah.
It's like Donato didn't make it back on.
You might be having the same issues. I'm on my phone. Like I have a camera here, and but I'm looking at my phone, so if it looks a little weird, I'm sorry.
No, it does that. Yeah, it's good. We just take turns every week having problems,
Yeah, there's always something.
Yeah, I mean, one of the great things, working with Lisa over the years and the folks with multi-capital partners and multifamily mindset, we really developed a risk management strategy. We looked at analyzing the properties, what we've done in the past, be able to really share that with the underwriters in the markets, and trying to educate like everybody. I made a commitment for the folks that are in the group that are reaching out is, even if I can't help them directly, as far as placing it, like, because right now I'm just doing consulting and advising work, but like if they have questions, we're here to help them understand what to look for when they're going out to the local agent broker, if that's who they're using, you know, to understand, because there's Lisa knows. I mean, when I left Marsh, I mean, I called a bunch of agencies just to see who would be good for us to place business with on future acquisitions. And a lot of people don't even know their stuff. There's a handful out there. There's quite a few folks, and a couple do their own podcasts and very knowledgeable, and a great resource and really understand. And those are the folks that you want to be able to use. But we looked at it, and having the right people on the team and understand when person's giving you advice based upon that's their thing. That take it into consideration, and don't try to tell me that we have a $20 million property, we only want to insure for 5 because, like, hey, we're not going to have a fire all the buildings. It's
Right. There's
that's
Too
not how
much risk.
it's not how it works. But
Yeah, but
develop a
if
strong
you have
relationships.
somebody, you have some like relationships. If you have somebody like Nico, who, I mean, you proved over and over how much you actually cared about us, and I think a lot of your clients, because when you couldn't, you stopped working for that company and you couldn't even represent us anymore, you could have just said, well, good luck to you, and whatever. But you actually spent a lot of hours, a lot of time and effort finding us somebody that you could hand us to, because you didn't want us to just go off to just anyone. And then you found us Cameron Stewart. And a lot of people are, use Cameron now, but he's been great.
And
But
like I said earlier, like, so you got spoiled. So I definitely
got
went above and
spoiled.
beyond what the typical
Good.
brokers have done. But
Yeah.
working on, and this is having somebody on your team too, to make sure that your schedule of values on the properties is updated and realistic, and you're getting updates from your property management company, and updates are being done. You have your schedules for when the HVAC systems were done, and electrical. Those are all things that you want to be able to keep track. I mean, Adam, going back, market research and data is helpful on our business, right? Because it's all about numbers. And we start diversifying in your multiple states, like, kind of know, especially when claims come up, that it's being handled and being done. But there's some folks that are out there, but typically, and Cameron's great. Cameron's been a great resource. Um, been able to, he's been able to get stuff placed. Um, it's on my end, be able to like negotiate with a broker, but, like, cause I understand what's going on. Like, oh, I need you to go back to your underwriter and like push for this. And this is what we've been able to do in the past. And this is kind of what we need. And, and doing that. And there's only so much pushing you can do, on it, because it comes down to, everybody's, looking at, the overall risk and the cost. And again, we try our best to get it down, and we just have to be, realistic on some of it. But if you're underwriting a deal and the numbers are tight, and you think by saving $1 more on the insurance is going to make the deal, like that's not it.
Do
You should
it.
not, like, the insurance should not make or break a deal. Even though it's breaking deals in Texas right now, but really, give yourself that cushion. And again, your Geico commercials are not geared towards commercial property. Like, it's not your auto.
Our sponsor would not let us do that.
No,
No,
no.
just like put it out.
Yeah,
Yeah,
because
back to getting
and
good
that's,
guidance.
well, that's the thing, is you have to make sure that you underwrite it with higher insurance costs, and if it comes in lower, great. But what we learned the hard way so many times is that you're not actually getting, like Nico said, he's not going to give you a quote. He can give you an idea, but you don't actually get the quote until you're close to closing. By then, you're in it. You can't get out. You've got non-refundable money. You've got investor money. You're stuck. So it's really tough. And that's the situation we ran and why we underinsured. It's not a good excuse or reason, but that's what happens is we were, it was too tight. So the lesson on that is make sure that you are way high on insurance costs from the front end. And that way, and it'll protect you on the back end.
Well, so on that one case where we ended up replacing it lower, so we were in line for what we estimated for the insurance, but it was the other factors that came into play that would have reduced the loan proceeds. So it was like, well, what can you do? And it's like, well, we're going to go to insurance to reduce it. I'm like, you can't. So, but like, to get the deal to work. I mean, ultimately, I think insurance and risk management, they're definitely critical components of any real estate investment strategy, and as rates continue to increase, and the big thing is as far as like replacement costs are severely lacking behind on what the current market is. And the insurance carriers are pushing for them higher because listen, you can't rebuild an multifamily property for $50 a square foot, 70, 100. Like it's not happening. I mean, it's realistic. When you go to Lowe's or Home Depot, look how much a sheet of plywood is. Like, so, getting those kind of in line to market values, it's going to be more important for investors to really work with, insurance advisors to really have the experience to make your team feel confident and up to date as far as what they're going on and the properties are adequately insured. And you have the right coverages in place, like comprehensive, like you got, again, we can't insure for everything, and insurance is just a tool that's there. And, knowing on, what we want to self-insure, how much risk that we're able to take on. So, those all great things. I appreciate, having the opportunity to come on and share. So
Thank you.
Yeah, we loved having you. Do we want to jump into trivia?
Yeah. And no more final pressing questions.
No, that was great.
I think you were very thorough.
Yeah.
We might get, if we have any questions from students though, I'm sure.
Yeah, reach out to share my contact info to make sure they reach out to me at the right one. That's there. But looking at it, just again, sharing the experience that we have. And if you have several different portfolios and you really need to have a risk manager on, but you can't have one on, I'm doing that as far as outsource. We can do it, look at each project, or we can look at it on an annual basis. All right. What's the trivia?
On to the commercial multifamily Lion's Den trivia time. Okay, so for the first question, economic vacancy takes into account both physical vacancy and units that are occupied but not generating rental income. This definition of vacancy takes into consideration the fact that some occupied units may not be generating rental income due to factors such as renovations, tenant turnover, or temporary market conditions. According to CoStar, in Q2 of 2020, the economic vacancy rate was 9.2%. What is the national economic vacancy rate for multifamily properties in the United States as of Q3 2021?
2021? Quarter was, what quarter was that you said in 2020? That was at 9?
2020 was Q2, and now it's a little over a year later at Q3 21.
Was 9.2 is the vacancy rate? I don't think that it got a lot better. I think it got worse.
Yeah. I'm going to say about the same. I'm going to say 9.
I'm going to say 12 and a half.
12.5. You got a rough answer?
Government agencies started.
We're all guessing. Don't worry about it. We're all guessing.
I'm going to say 6.8%.
Did you Google that?
No, I pulled up ChatGPT.
You're not allowed to do that. That's what our guest last time did.
Well, I mean, that's 7.6%.
Wait, which
I think
quarter
he was
did you
closest.
It was Q3 of 2021, and it's economic vacancy, not just physical.
Okay, so then in my opinion, if it went down, then it was because government agencies started helping out a lot of people that weren't paying. Because in 2021, we still had a lot of people not paying rent. But government agencies started kicking in and paying it, so that helped a lot.
Yeah, I mean, definitely. I mean, we had taken into account the whole pandemic with all that, right? So we had supply chain issues at time.
A lot of people
Um,
stopped working. Stopped
The
paying.
eviction moratoriums were going into play. Like
Yeah.
they said, the government programs.
Okay. Next question.
No Googling.
No Google.
Lead-based paint is a type of paint that
Ooh,
contains
is it?
high levels of lead, a toxic metal that can cause serious health problems if ingested or inhaled. Lead-based paint was commonly used in homes and other buildings before it was banned in what year?
1965.
1978. Or
You're a real estate
1979.
It might have been
No.
later.
1979.
I think it was 78, but I know like
78.
as a kid, like we used to bite. I mean, my crib had like lead paint on it, and we used to chew on.
That's
lead
what's
paint.
wrong
So,
with all of us.
Yeah. Hey, listen, like
Right.
a thermometer broke, right? And so here we were on the floor playing around with the mercury. Like we didn't know back then.
Oh my God,
Um,
I know, right?
But let's say I'll say 78.
Lisa say 79.
No, I said 78. And then I
thought you
questioned
changed
myself,
it.
but it's 70.
Yeah,
It's 78.
It is 78.
I was
Go for test
thinking, I
or-
think of when they were using it a lot,
Well,
not when they
so-
banned it.
Well, listen,
Oh my God.
cheers to the Gen Xers that we chewed on the windowsills with lead paint.
We all have health problems.
Hey,
All right.
you know,
But who
Maybe it
knows?
just made you
Good thing I
strong.
know why now. No.
I don't think it did.
hey,
But no,
back in the day-
if I would have gotten that wrong, though, I've been a broker for 20 years. It's like one of the first things that you learn.
Right. All right.
Hey, back in the day, we used to play down in the basement and hang off the pipes on the ceiling and didn't know like the white stuff coating it was asbestos. Like, who knew?
Right. Yeah. Lots of stuff.
All right. Final
Now
question.
we're dating ourselves.
According to the National Fire Protection Association, what percentage of reported multifamily residential building fires in 2019 were caused by cooking equipment? This is kind of an insurance question.
That's a good one.
In 2019,
Yeah, 2019.
75.
37, 35.
Oh
38%.
gosh. Oh wow. I'm way on.
I'll say 55.
It's got to be at least a third fire.
Seems like it would be a lot.
Okay,
I saw a
so
commercial recently that said like it was a high number that most of them are caused by the kitchen.
cooking equipment was the leading cause of reported multifamily residential building fires in 2019, accounting for 33% of these fires. So Nico was very close.
Wow.
Yes. Good job.
Almost like you do this for a living.
Almost like he doesn't.
Right. I said like 75%.
Hey, listen, I just saw like attorneys, right? 33.3% to like 32. Like a third.
Yeah. Nico wins.
Thank you so
I
much
guess
for
I got-
coming on, Nico. Yeah,
Thank
where can people
you.
contact you?
We can share my email and phone, probably email.
I'll put it in the description.
Yeah, but I mean, really, it's been a pleasure, and I mean, the honor's been mine. Working with Mama Lisa for 14, going on 15 years, and starting off the small ones, and going through, and I got to see her grow with her portfolio, and she's got to see me grow as far as with my experience, and working with
Yeah.
global brokerages and with some big investors on it, and be able to share. I mean, I'm very passionate. Hey, listen, I'm a geek. I love properties, like all different forms, and kind of looking at it. And it's a different perspective because like, even when we're going out looking at stuff, it's, it's just having different eyes. And that's why you have different people on your team. So thank you for giving me the opportunity to share. And I can't wait to see you as a person again.
Thank you, Nico.
No, my pleasure. Thank you.
Thank you for listening to the Commercial Multifamily Lion's Den podcast. If you enjoyed today's show, make sure to leave us a like, subscribe, and share with anyone you think gained value from today's episode. What obstacles are you facing? Let us know in the comment section below, and we'll get to it in a future podcast. If you're interested in passively investing with us, you can go to am-multifamily.com, or you can email Fia, am-multifamily.com. Those links will be in the show description, along with the Lion's Den Facebook page and website. Thank you, and have a roaring day.